Good morning, everyone. I'm Wes Burke with Central Coast Lending. Welcome back after the holiday weekend. Rather than just talking about where mortgage rates are today, let's look at the market through the eyes of a secondary marketing desk. If you sat down next to an MBS trader this morning, they wouldn't be talking about mortgage rates. They'd be talking about volatility, liquidity, and whether MBS are finally starting to behave. Mortgage rates are beginning the week around 6.54%, while the 10-year Treasury is near 4.48% after a quiet overnight session. The market has shifted from reacting to every geopolitical headline to waiting for its next major catalyst. Oil prices are easing on supply expectations, which relieves some inflation pressure. Today isn't expected to move markets much. Sometimes no news is good news. Here's the inside baseball. Mortgage pricing isn't determined by Treasury yields alone. It's determined by how investors value MBS relative to Treasuries. Think of Treasury yields as the foundation. MBS are the house built on top. Right now, traders are watching whether MBS spreads can stabilize. If spreads tighten, even without a big move lower in Treasuries, retail mortgage pricing can improve. That's something consumers rarely hear about, but every secondary marketing manager watches every day. As rates have stayed above 6.5%, refinance activity is subdued, which reduces prepayment risk. Ironically, slower refi activity can make MBS more attractive to institutional buyers. This week's calendar isn't packed with major reports. The focus shifts to the Fed. Meeting minutes drop Wednesday, and traders will be looking for clues about how committed policymakers remain to their recent hawkish tone. Markets already know where rates are today. What they want to know is whether the Fed is becoming more comfortable with inflation or more concerned. If the minutes sound even slightly less hawkish than expected, the bond market could respond favorably. For loan officers, the practical takeaway: don't get caught watching only the 10-year Treasury. Watch lender reprices. Watch MBS performance. That's where mortgage pricing is actually happening. If spreads keep improving this week, some lenders may become more aggressive, even if Treasury yields don't move. Those windows often open and close faster than borrowers expect. The loan officers who stay engaged with clients during those periods are usually the ones who capture the opportunity. Here's today's bottom line. The market feels different than a few weeks ago, not because everything is bullish, but because volatility is easing. Bond traders are becoming more selective about what actually moves the market. That's a healthier environment for MBS. If inflation keeps cooling, if oil stays contained, and if MBS spreads keep tightening, there's room for mortgage pricing to gradually improve. Not dramatically, not overnight, but enough that staying engaged with borrowers matters. Thanks for watching. I'm Wes Burke with Central Coast Lending. If you're running a mortgage company on a broker model, I'd like to talk about shifting to a correspondent model. CCL can become your back-end provider, improving your rates, transactional control, and speed while you preserve your brand. Reach out to learn more.